In this recording, we're going to talk about errors in inventory because they're very common, and that at the same time, they can be very confusing for the accountant to figure out how to correct them. It's very common to make errors in the purchase decision. Keep in mind, it's going to make a difference on those shipping terms, whether goods are FOB destination or FOB shipping point. So it's very common right at the end of the year to make errors, either to overlook recording a purchase or record a purchase that we don't actually have legal title to yet. So that's a common error. Another really common error occurs during the counting of the inventory at year end. It's real easy to make a mistake there. So we're going to look at what's the impact. And the other is that goods that are owned that are in transit. So if the goods are owned but they're in transit, then usually the purchase hasn't been recorded because we don't have the goods yet, and the goods are not included in ending inventory either. So we want to look at, well, what about that unique situation? So we're just going to kind of in theory go over these three scenarios, what's the impact on the income statement, and then I've listed the relevant accounts for the balance sheet. So again, on the income statement, sales as our cost of goods sold, we're going to look at beginning inventory, add in purchases to arrive at goods available for sale, subtract the ending inventory to get cost of goods sold, assuming that we were using this process. And then cost of goods sold, take that away from sales and we'll get gross profit, and then all the way down to net income. Well, we're going to assume then, that sales is okay, and that, our beginning inventory as well as that we're okay there as well. We want to make that, we're going to assume the error is in the purchases and that we overstate purchases in year one, that we're going to record too many. So we may record a purchase when we don't actually own the goods yet. So if we overstate purchases, then goods available for sale will be overstated as well, right? Beginning inventory plus purchases, goods available for sale. Now let's assume that's the only mistake that we make. So let's put this maybe in a different color just to highlight. So the error is going to be with purchases. So not counting ending inventory. So when we go over here, sorry, I meant to make that black. So if our goods available for sale is too big, but we take the right amount to ending inventory, then we're going to be overstating our cost of goods sold. And just recall, here's our goods available for sale. That's everything that we're holding out. Generally speaking, if we kind of disregard theft and that sort of thing, either we have sold the goods or we haven't. So either we are costing the goods in the cost of goods sold, or they're still on hand in ending inventory. So that's what's going on right here. Of goods available for sale, if this was too big and we put the right amount in ending inventory, then cost of goods sold is going to be too big. Okay, let's go to gross profit. So sales is okay, but we've got too large of an expense. We're overstating cost of goods sold. In that case, our gross profit is going to be understated or too low. Okay, nothing's going to be wrong with operating expenses. So operating income is going to be too low or understated. Income tax expense is based on that, so it's going to be too low as well. And then we'll just continue on. If that was a 30% tax rate, the net income will be 70% of our operating income, and it's going to be understated as well. Okay, let's go down to the balance sheet then. It's going to be our ending inventory, right, is going to go on the balance sheet. It's okay, so nothing wrong there. Accounts payable. Well, right at the end of the year, again, is when these purchasing mistakes take place. So if we recorded purchases as too much, well, the other side of that is accounts payable, correct? We debit purchases, if this is periodic. We debit purchases and we credit accounts payable. So this is going to be overstated as well. For retained earnings, net income flows into retained earnings. So that's what's going to have an impact on retained earnings, and it's going to be too low. So we can see then accounts payable and retained earnings, those are really just offsetting each other. They offset one another. Okay, so that's the first year. Then let's go to the second year, again, assuming no error in inventory. Ending inventory becomes beginning, so that's okay. So again, right, ending inventory becomes beginning. If we recorded too many purchases in the first year, again, assuming this is right at the end of the year for year one, around in December or January, looks like we took some of January's purchases for year two and recorded in December for year one. If we did that, then our purchases for year two will be understated. They'll be too low. If that's understated, goods available for sale will be too low. It will also be understated. Assuming we don't make a mistake in counting our inventory, cost of goods sold is going to be too low. So again, we have too small amount in goods available for sale. If we put the correct amount in ending inventory, cost of goods sold will be too low or understated. Gross profit is sales less cost of goods sold. If we have too small of an expense, we will overstate that. So operating income will be too big. Our income tax expense is based on that, so it's going to be overstated. Net income then is the other 70% of that, so it will be overstated. Let's jump down to the balance sheet. Ending inventory, second year, it's okay. Now let's think about accounts payable. Purchases is understated, but that actually, the error took place, right? December, January. December year one, January year two. Those payables would be paid by December 31st, year two. So this is going to be okay. Again, this understatement took place in January of this year. So those would be already, we would have paid those accounts payable. Those aren't going to carry forward to December 31st. Also, for retained earnings, both of these, year one and year two, would be close to retained earnings. Those will offset each other, and retained earnings will be okay by the end of the second year. So here's the conclusion. By the end of the second year, errors in inventory self-correct. That's because inventory is a current asset. So, it only exists for less than a year, so it will self-correct over 2 years. All right, let's go to errors counting inventory. So again, we're going to assume nothing's wrong with sales or purchases. So beginning inventory is okay, purchases, goods available for sale will be okay. But let's say when we go in to count this ending inventory that we overstate it. That's going to be our error. That we count too much there and overstate that. If we do that, cost of goods sold will also be too large. It'll be overstated. Yep, I said that wrong, didn't I? Let me change that real quick. The cost of goods sold will be understated. Let's look at that again. Goods available for sale is okay. We put too much in ending inventory, so to balance that out, cost of goods sold will be too low or too small, so understated. Okay, moving on, sales, less cost of goods sold. We have too small of an expense, so it's going to be overstated. Assume nothing's wrong with operating expense, then operating income, taxes based on that, and net income will all be overstated. Going on down below, ending inventory, right? We said it's too big, so it's over. Accounts payable, nothing's going to be wrong with the purchases, so it's okay. And then net income is overstated, so retained earnings will be overstated. So assets And then on the other side of the balance sheet, retained earnings will both be overstated. So we will have inflated our balance sheet. Assets too high, retained earnings too high. Let's go to the second year. Ending inventory becomes beginning inventory. So that will carry over for the second year. Assuming we have no errors in purchases, so then our goods available for sale is overstated. Again, we won't make an error this time counting ending inventory, so cost of goods sold is too big, it's overstated. So goods available for sale is too large. We put the right amount into ending inventory, so we have too much in cost of goods sold. If our expense of cost of goods sold is too big, then gross profit will be understated or too small. Okay, and then everything after operating expenses will be under. Okay, moving forward, ending inventory is okay. Nothing was wrong with purchases and accounts payable. And then for retained earnings, these two net incomes counterbalance, and it's going to be okay. So again, we can see that errors in inventory self-correct over 2 years. Okay, the last one, goods that are in transit. Perhaps, it's it's probably this would be FOB shipping point. So if the terms were FOB shipping point, then the goods could be in transit, but we own them. Shipping point. The goods are in transit, we own them, but we wouldn't have recorded them, and we haven't counted them because they haven't arrived yet. Okay, so again, nothing wrong with sales, nothing wrong with beginning inventory, but we wouldn't have recorded the purchase, so the purchases will be understated. So if purchases is understated, then goods available for sale will also be understated. So that's one of the errors. The other error is that the goods aren't on hand, so we didn't include them in ending inventory. So there again, we understated ending inventory. So we have two errors, don't we? Both purchases and ending inventory. These two will offset each other, and cost of goods sold ends up being okay. And if sales and both cost of goods sold are okay, then gross profit and everything below it will be just fine as well. So for the income statement, this kind of error has minimal impact on the income statement. Now when we go to the balance sheet, that's a little different story. Ending inventory goes on the balance sheet, so it's going to be understated. Purchases, which impacts accounts payable, will be understated. But our net income flowing into retained earnings is okay. Okay, year 2, ending inventory becomes beginning inventory. Okay, so if sales was okay, and then purchases. If purchases was understated last time, then we're putting too much into it the second year. So it's going to be overstated. So we have beginning inventory and purchases. So if purchases was too low last year because we didn't record something, that means we recorded it year 2 and we're putting too much into year 2. Too many purchases in year 2. Then those offset each other and everything ends up being okay. So all the way down, everything is just fine on the income statement. So here again, there's minimal impact for this kind of error on the income statement. When we get to ending inventory, it was okay. Purchases, this overstatement would have occurred in January of year 2, Accounts payable would have been paid, by February probably. So that will not carry forward to December 31st of the second year, and nothing's wrong with retained earnings. Moving on to exercise 4. So let's get some application of these accounting errors. In exercise 4, I want to point out exercise 4 assumes a perpetual inventory system. In a perpetual system, recall, purchases get recorded in the inventory account, purchase returns get recorded in the inventory account, cost of goods sold gets recorded in the inventory account. So there's a perpetual record updating the inventory account for every sale and every purchase. It also mentions that the books have not been closed. That means revenue and expenses have not been closed to retained earnings. So if we need to make a correction to an expense account, we can do that. Okay, I'm only going to look at a couple of these. I want to look at number 1, and then we're going to look at number 4. And we're being asked to record the journal entries. Well, there's a couple of things you really need to think about when you're solving for accounting errors. First, we have to determine, do we own the goods at December 31st? In this case, if we're accounting for the buyer, well, I guess, or even the seller, who owns the goods? Well, that's where these shipping terms come into play. FOB shipping point, FOB means free on board, but shipping point is when legal title will transfer. So title transfers when it leaves the seller's place of business. That's the shipping point, at the seller's place of business. FOB destination is the buyer's place of business. So if the shipping terms are FOB destination, then title transfers when at the buyer's place of business. So again, the goods are being shipped from the seller to the buyer. So the question is, does title transfer here at the seller's place of business? It will transfer there if the terms are FOB shipping point. Or does title transfer when the buyer receives them? That would take place if the terms are FOB destination. The second question is that we want to ask ourselves is, have we recorded anything previously for these goods? And if so, we may need to correct it, or if we didn't, we may need to make a journal entry. Okay, so let's look at the first one. We have an invoice for $8,100, terms FOB destination. So that means title's going to transfer here. I'm sorry. Yes, was received and entered on January 2, 2014. So we have an invoice that was received, right? We're the buyer, so we've got an invoice that we received in 2014 or January 2014. Now the receiving report shows that the materials were received on December 28. So we really have to understand, what are these documents? Because they're telling us, it's seemingly like they're telling us two different things. The sales invoice is prepared by the seller. It's going to tell us about the quantity of goods, it'll tell us about the sales price, and the shipping terms. The receiving report is something, if we're the buyer, we prepare, and usually it's our employees on the receiving dock. So that's going to tell us, when did we receive the goods? So in this case, the receiving report, that's the document that's relevant to us. It's going to tell us when legal title transferred. So if the terms are FOB destination, we received the goods in 2013. That means we own the goods in 2013. Okay, now back up here, it says we recorded all of this. So we made a journal entry though in 2014. Well, what would that entry have meant? Well, it probably was a debit to inventory and a credit to accounts payable, and we'll have to go into 2015 and reverse that. This is really just asking us for the entry for 2013. So in 2013, so 12, 31, 2013, we need to make a journal entry to record the purchase, so we'll put that in the inventory account, the $8,100. And we're also going to credit to increase our accounts payable $8,100. Again, We also would have to get out of the 2013 records and go to the 2014 records and reverse that entry we made there. But it doesn't really ask us to do that. It just asks for this entry. Let's go ahead and look at number 4. On number 4, we have an invoice for $7,500 terms FOB shipping point. That means title would transfer at the seller's place of business. And that invoice was received and entered December 30th. The receiving report shows the materials were received January 4, and the bill of lading shows that they were received January 2. Well, let's go and look at what do we have going on here. So let's back up. We have an invoice, and we received that December 31st. So we've got an invoice coming in 2013. And, I went the wrong way, sorry. Invoice, and then we have our receiving report for January 4. And this time we have another document called the bill of lading, and that's January 2. The bill of lading is a document created by the transport company. So let's say it's a trucking company, and so this is telling us the goods were shipped on January 2. So if the goods were shipped on January 2 and title transfers at the shipping point, then that means title transferred here. So the buyer does not own the goods until, so title transferred January 2, that means the buyer doesn't own the goods until January 2. Okay, so have we recorded anything? Well, it looks like we did. We made a journal entry on December 30th. Well, what would that entry have been? Well, again, we probably debited inventory and credited accounts payable for the $7,500. So that was our original entry. But we can see we shouldn't have made that entry because we don't own the goods until January 2. So we need to make a correcting entry. So our correcting entry, we want to get it out of accounts payable and take it out of inventory because it shouldn't have gone into those accounts. So we're going to take it out of accounts payable, take it out of inventory, and there's our correcting entry. Okay, moving on to exercise 5. Exercise 5 is not a perpetual system, but a periodic system. And again, the books have not been closed, so we can make correcting entries. We have a whole bunch of information given to us. The first one tells us there's been a physical count, and that's 234,890. And then we have all of this other information, and they want us to figure out the correct balance for ending inventory. So I've gone ahead and listed transaction 2 all the way through 8, and then we'll figure out what the real balance should be. We're also, if any of these require a correcting entry, we're to solve for that on here. I want to review the periodic system with you real quick. Recall the periodic system, when there are purchases, those will go in the purchase account. So like this $20,000, it was recorded in purchases. And I also want to point out there was a beginning inventory of 80. Notice purchases does not go in it. When there was a sale, we record the sales revenue, but there's no journal entry for cost of goods sold. So notice nothing has been recorded in cost of goods sold at this point. So what happens at the end of the year, we want to record cost of goods sold. So the way to do that, is to take this beginning inventory and put it in cost of goods sold. So we have a debit to cost of goods sold of 80,000. I'm going to just post that. And then we credit inventory 80,000. Right now, then, there would be a zero balance in inventory, right? We also want to move purchases to cost of goods sold. So that would be debiting cost of goods sold $20,000 and then recording that as a credit to purchases. Okay, so then we have, I see I made a mistake there. We have a debit and credit to purchases. It has a zero balance right now. Then the last thing we do is we physically count our inventory. And they go in and count 60,000. So they want to put that ending inventory, 60,000, into the inventory count, that's number 3, and then we credit cost of goods sold for that. So what we have then is beginning inventory plus purchases. That would give us $100,000 of goods available for sale. We subtract ending inventory, and then that would give us a cost of goods sold of $40,000. It is this entry right here, this physical count, that we are solving for in exercise 5. So we're doing all the stuff up above really just to figure out what the debit to inventory will be and the credit to cost of goods sold. Okay? All right, so let's go back. Okay, so we'll go through a few of these. I probably won't go over all of them. Let's look at number 2. Not included in the physical count is $13,420 of merchandise purchased on December 15 from Browser. The merchandise was shipped FOB shipping point on December 29 and arrived in January. The invoice arrived and was recorded on December 31st. So if we go back to our, our 2 questions, do we own it? And 2, have we recorded it? So 2, yes, we have. So we do own it. It's FOB shipping point. So title transferred when the goods left the seller's place of business. So we own the goods. We got the invoice before year end and we recorded it. But what we didn't do is that the goods were not included in our physical count. So we need to add that $13,420 of goods to our ending inventory. They just didn't get included in our physical count. Let's do number 3. Included in inventory is merchandise sold to Champy on December 30th, FOB destination. This merchandise was shipped after it was counted. The invoice was prepared and recorded as a sale on account for $12,800 on December 31st. The merchandise cost $73.50 and Champy received it on January 3rd. So we own the goods in this case, and we've recorded them, and we also included it in our ending inventory because it was included in the ending inventory count. So we really don't need to do anything here. However, we do need an entry because these goods were returned. So let's look at a correcting entry because the sale didn't take place until the following year. So for number 3, we need a correcting entry. We want to, reverse our sales entry, take it out of sales, $12,800, and also take it out of accounts receivable. We would have had a sales entry for that. We don't have to make a journal entry for cost of goods sold because this is a periodic method, right? We don't record cost of goods sold at the time of the sale. We would have just done this, and so we're just reversing that out. Number 4, included in inventory was merchandise received from Dudley on December 31st with an invoice price of $15,630. The merchandise was shipped FOB destination. The invoice, which has not yet arrived, has not been recorded. So for number 4, the goods have been included in ending inventory, so we don't need to make any adjustment here, but the purchase has not been recorded. So we need to go over and make a journal entry, record our purchase, and an increase to accounts payable, $15,630. And I'm going to skip down to number 8. Excluded from inventory was a carton labeled, "Please accept for credit." The carton contains merchandise costing $1,500, which had been sold to a customer for $2,600. No entry has been made on the books to reflect the return, but none of the returned merchandise seemed damaged. Okay, so they set this aside, so they did not include it here in their ending inventory. So if goods have been returned, we want to put them back and sell them again, right? We want to put them back in our inventory and sell them again. So that should have been included there. And we also haven't recorded the sales returned. So over here, let's go over. We want to record sales returns. And reduce our accounts receivable, $2,600. Okay, so going through that. Okay, other things, just because this gets kind of long and tedious, I'm just going to kind of go through. In number 5, you're going to see that the goods were recorded accurately. The goods were recorded accurately, but they didn't get counted in ending inventory. So we need to put the $8,540 in the ending inventory. On transactions 6 and 7, we'll have just the opposite. We have goods that were included in inventory and shouldn't have been. $10,438. And likewise, $10,520. Again, goods that should not have been included in ending inventory. So we want to take them out. Okay, so I start with my $234,890, net all of this, and we'll get $237,392. And going through that.